In this video, I'm going to walk you through different cash storage options, evaluating each on 4 key criteria: risk level, interest rates, liquidity, and ease of management. We'll also cover who each option works best for and in what situation. Alright, with that, let's dive in. First up, we have your very boring and vanilla regular checking and savings accounts. In America, checking accounts became widespread in the late 1800s, revolutionizing commerce by eliminating the need to carry large amounts of cash. Savings accounts emerged slightly earlier in the early 1800s when mutual savings banks were founded to encourage thrift among the working class. For most of the 20th century, checking accounts paid no interest by law under Regulation Q, which wasn't fully repealed until the 1980s. During the early 1980s, savings accounts commonly offered double-digit returns, making them genuine wealth-building tools. However, decades of declining interest rates following various economic crises have fundamentally changed their role in personal finance. Today, regular checking and savings accounts primarily function as financial utility rather than any form of a wealth-building vehicle. For most people, it simply serves as a hub where money flows in and out, receiving our paycheck, paying our bills, and paying for our mortgages. And you'll see why when we review their specific features. First, let's talk about its interest rates. Today, regular checking accounts at major banks like Chase, Bank of America, and Wells Fargo typically offer 0.00% to 0.1% APY, while regular savings accounts offer 0.01% to 0.45% APY, with some credit unions reaching as high as 1%. These rates are essentially unchanged from the post-2008 era, despite the Federal Reserve raising rates. Essentially, every dollar you keep in your traditional checking and savings accounts are losing value to inflation every single day. But why do pretty much all of us use them? Which leads to the next characteristic: risk. The risk to your principal is virtually zero, thanks to FDIC insurance covering up to $250,000 per depositor per bank. This government-backed guarantee means that even if your bank fails completely, you'll get your money back up to the coverage limit, making these accounts as close to risk-free as you can get in the financial world. And liquidity. Liquidity is maximum for checking accounts. Your funds are available instantly through debit cards, ATMs, checks, and online transfers with no penalties. Savings accounts offer excellent liquidity too, with transfers to checking accounts typically instant. And finally, ease of use and management. These couldn't be simpler, as most people can easily open these accounts with their local bank and instantly manage them via mobile app and ATM access. So who is regular checking and savings accounts best for? They're an almost necessary tool for people who need immediate access to funds for daily expenses and bill paying, plus a simple mechanism to separate savings from spending money. So how much to keep in these accounts? The best rule of thumb is to keep enough in your checking account to cover only your monthly expenses and use savings for small amounts you're accumulating before moving to higher yield alternatives. However, for any substantial savings goals or emergency funds, the opportunity cost of earning virtually nothing while inflation runs around 2% makes them unsuitable for anyone serious about saving. Alright, moving on to the next option for your cash. Next, we have the relatively popular, high-yield online savings accounts. Online banks emerged in the 1990s, but didn't gain mainstream acceptance until the 2000s. The 2008 financial crisis actually helped legitimize them as people sought higher yields and realized the FDIC insurance made them just as safe as traditional banks. These banks can offer superior rates because they have dramatically lower overhead costs, no physical branches, smaller staff requirements, and lower operational expenses. And more recently, the rise of smartphones and improved online banking technology has made the online-only model increasingly attractive to consumers who prioritize yield over in-person service. Alright, let's take a look at how they compare against our traditional checking and savings accounts. When it comes to interest rates, the current high-yield online savings accounts are the standout performers in today's rate environment, offering 4% to 5% APY at top institutions. Just to put that in perspective, these rates are 50 to 100 times higher than traditional savings accounts and actually competitive with current inflation. When it comes to risk, it's also quite competitive because just like traditional checking and savings accounts, they have full FDIC insurance protection. Its main risk primarily comes from interest rate fluctuation if the Federal Reserve cuts rates. Liquidity is also excellent with no withdrawal penalties and most allowing unlimited transfers to external accounts, though ACH transfer typically take 1 to 3 business days. Ease of use and management is also great. If you want to use an external checking account, it requires linking them for transfers. However, because most of these banks, being primarily an online bank, are pretty savvy with technology, they usually have excellent mobile apps and provide excellent online experience. The main downside is that you will not have the in-person service of traditional banks. Though I can't say that having a physical branch makes much of a difference in today's digital world. Personally, despite having a bank account at one of the traditional banks, I can't remember the last time I visited a branch for anything. And to be honest, I have no desire to. Alright, so who are high-yield online savings accounts ideal for? I say they're ideal for anyone with an emergency fund or short-term savings who want competitive interest while maintaining safety and reasonable liquidity, which is pretty much all of us, right? Additionally, they're ideal for people who are comfortable with digital-first banking experience and who prioritize yield over branch access. The rate advantage is so substantial that in my perspective, they should be the top choice for most emergency funds and short-term savings goals. Alright, so before we get to our next best place to hold our cash, some of you guys watching this video is like, wait, I need a high-yield savings account. But where should I open one? Well, if that is the case, I highly recommend you check out SoFi and their checking and high-yield savings account, who I'm partnering with for today's video. Not only does SoFi offer very competitive rates, allowing you to earn more for your dollars, when you sign up and set up direct deposits, you can earn up to $300. Additionally, with SoFi, you have access to additional FDIC insurance up to $3 million. But that's not the best part. This is my personal favorite. You pay no account fees. Many traditional brick-and-mortar banks are known for their death by thousand cut strategy, essentially finding ways to charge their customers for every possible fee. Account fee, monthly fee, overdraft fee, etc. Well, SoFi makes things super simple. No account fee, no overdraft fee, no minimum balance fee, no pesky monthly fee. Banking should not be complex. You are a busy individual. There are so many things you need to juggle as a busy professional. Your work, your team, your family. The last thing you should be spending your precious time on is constantly checking your accounts to see if you're meeting the minimum balance requirement so you can avoid account fees. Well, with SoFi, no more. It is a no-frill bank that gives you exactly what you need. So if you're in the market for a great online bank, make sure to use my special link, sofi.com/tay, and check them out today. I'll also have a link in the description below. Alright, with that said, let's get back to the video. Alright, next we have the money market account, aka MMA, as another option to hold cash. Money market accounts were created in 1982 as banks' competitive response to money market mutual funds, which were draining deposits by offering significantly higher yields than traditional bank accounts. These accounts were specifically designed to combine the yield advantage of money market investments with the safety and convenience of traditional bank accounts. The name reflects their origin in money markets, the short-term lending market where financial institutions borrow and lend to each other. Initially, money market accounts offer rates competitive with money market funds, making them attractive alternatives for savers seeking both yield and FDIC protection. However, in the recent times, money market accounts have become somewhat of a middle child in the banking world, offering slightly better rates than traditional savings accounts, but falling short of what you can get from a high-yield online savings account or money market funds. Alright, let's get into specific characteristics. When it comes to interest rates, today's money market accounts at traditional banks typically offer 0.5 to 2.5% APY, with rates often tiered based on balance levels. Many require $10,000 or more to earn the advertised rate. Online banks and credit unions frequently offer higher rates, with some reaching 4.3% APY. Risk remains minimal with FDIC insurance protection, though inflation risk remains with lower yielding accounts. Liquidity is good, but comes with some restrictions. You typically get check writing privileges and a debit card, but may face a traditional 6 withdrawal monthly limit. When it comes to management, balance requirements can trigger fees if you fall below the minimums, requiring careful monitoring, which from my perspective is quite silly in today's world, where many high-yield savings accounts have completely done away with such strict requirements. Bottom line, the real advantage of money market accounts is not necessarily the yield anymore. It's the hybrid nature. Money market accounts work well for people who want slightly higher returns than regular savings accounts while maintaining check writing and debit card capabilities. They're best suited for people with large balances who can consistently meet the minimum requirement and who value the convenience of having banking services bundled together. However, given that high-yield online savings accounts often beat money market rates while offering better terms, money market accounts have lost much of their competitive advantage in today's world. They're no longer the game changer they once were in the 1980s. Next up, we have the Certificate of Deposit, also known as CDs. Certificate of Deposits became popular in the 1970s as a way for banks to compete with higher yielding Treasury securities and to secure longer term funding. They were especially attractive during the high interest rate environment of the early 1980s, when CDs commonly offered double-digit returns, making them central to many conservative investment strategies. The concept is simple. You agree to leave your money untouched for a specific period in exchange for a guaranteed, typically higher interest rate than savings accounts. During periods of rising rates, CDs protect you from having to accept lower yields, while during falling rate environments, they lock in attractive rates. Alright, for the specific characteristics. When it comes to interest rates, CD rates range from 4% to 4.6% APY depending on term length and institution. What is interesting about the current CD market is that many shorter-term CDs have higher interest rates than longer-term CDs. Historically, the opposite was true. Longer-term CDs usually paid higher rates to compensate for locking up your money for a longer time. But because the banks are expecting the Federal Reserve to continually cut rates, they're willing to offer higher rates on short-term CDs to attract deposits. When it comes to risk, the risk to principal is minimal with FDIC insurance. But there are significant opportunity costs if rates rise substantially after you lock in. Liquidity is poor. This is one of the biggest downsides to holding CDs. Your money is committed to the entire term, and early withdrawal penalties can be substantial, often ranging from 3 to 12 months of interest. Management is simple once established, requiring no ongoing attention until maturity when you must decide whether to renew or move the funds elsewhere. CDs work best for people with money they know they won't need for a specific period and who want guaranteed returns. They're excellent for earmarked funds like a house down payment you're saving for 2 to 3 years out, or a portion of your savings that you're confident you don't need to touch. Also, given the current inverted yield curve, shorter-term CDs offer a pretty attractive return for conservative savers who want to lock in today's elevated rates. However, given the pretty competitive rates provided by many high-yield online savings accounts, the rate premium you get from CDs isn't always as compelling as it once was. You might find a 12-month CD offering a 4.5% APY, while a high-yield savings account is paying 4.25% APY. That's only a 0.25% difference for giving up all your liquidity for an entire year. Next up, let's talk about the money market funds, the distant cousin to the money market accounts. We're now slowly transitioning from the bank world to the investment world. Money market funds were invented in 1971 and grew rapidly through the 70s and early 1980s when they offer much higher yields than bank accounts, which were still restricted by Regulation Q. These funds invest in short-term, high-quality securities like Treasury bills, commercial paper, and bank certificate of deposit. The 2008 financial crisis led to increased regulation after the Reserve Primary Fund broke the buck, falling below $1 per share due to losses on Lehman Brothers commercial paper. Despite this hiccup, money market funds remain popular for cash management among investors who want slightly higher yield than bank accounts. Alright, let's discuss its specific characteristics. With interest rates, today's money market funds yield approximately 4% to 4.3%, often matching or slightly exceeding high-yield savings accounts, due to their ability to invest across different short-term instruments. However, when it comes to risk, unlike bank accounts, money market funds are not FDIC insured, though they're generally considered very low risk due to their investment in high-quality short-term securities and strict regulatory oversight. The main risk is a possibility of small principal losses if the underlying investments default, though this is rare. Liquidity is good but not as flexible as bank accounts. Money market funds require electronic transfers through your brokerage account and typically settle within 1 to 3 business days. Unlike money market accounts, these funds do not offer check writing privileges or debit cards. Management requires a brokerage account if you don't already have one, and yields fluctuate daily based on underlying securities, making returns less predictable than savings accounts or CDs. Money market funds work best for investors who already have brokerage accounts and want to maximize yield on cash while maintaining reasonable liquidity. They are particularly suitable for those comfortable with slight principal risk and the convenience of keeping cash within their investment accounts. They excel as a parking place for cash within investment accounts, though for a lot of people, high-yield savings accounts offer similar returns with FDIC protection and simpler management. Alright, so we covered a lot so far, so let's take a little water break. Are you a bit overwhelmed by everything I've covered so far? Do you wish you had a quick little cheat sheet you can reference? Well, I got you covered, my friend. For being a loyal viewer of my channel, I want to share with you an easy-to-digest summary of everything I'm covering in this video. What each cash option is, their unique characteristics, and how they compare to each other. A small token of appreciation for tuning into my channel, dedicating your precious time, and learning from my videos. And if you're not learning anything from my videos, at least you got to admire my ridiculously amazing hair for 15 minutes. So find the link to the free cheat sheet in the description below. Next up, we have US Treasury securities, specifically Treasury bills or T-bills as they're commonly known. T-bills have a fascinating history dating back to 1929 when they were first introduced by the US Treasury to help manage short-term government financing needs. Initially sold only to banks and large institutions, T-bills became available to individual investors in the 1970s when the Treasury began offering them through a competitive bidding process. The creation of Treasury Direct revolutionized retail access, allowing ordinary Americans to buy T-bills directly from the government without going through brokers or paying fees. What makes T-bills unique is that they're backed by the full faith and credit of the US government, making them arguably the safest investment in the world. They're considered a global benchmark for risk-free returns. Alright, let's dive into their specific features. When it comes to interest rates, T-bills currently offer yields ranging from about 4% to 4.5% APY depending on the term. 4 weeks, 8 weeks, 13 weeks, 20 weeks, or 52 weeks, with rates that move closely with Federal Reserve policy. Unlike savings accounts, T-bill rates actually reflect current market conditions. With risk, T-bills essentially have zero default risk since they're backed by the US government's ability to print money and collect taxes. However, there is interest rate risk if you need to sell before maturity and your rate is locked in for the entire term. Of course, nothing in life is completely risk-free, but in the world of investing, this gets pretty close. With liquidity, T-bills can be sold anytime through the secondary market. However, you often get the best returns by holding to maturity. They're less liquid than savings accounts, but more predictable than other investments. With management, you can buy T-bills directly through treasurydirect.gov with no fees or through most brokers, including Vanguard and Fidelity, making them surprisingly accessible for individual investors despite their institutional reputation. Now, you might be wondering how T-bills compare to money market funds since both are government-backed and offer similar yields. Well, let me highlight the key differences. 1. Direct government backing. When you buy T-bills, you're lending directly to the US Treasury with no intermediary. 2. Predictable, locked-in returns. You get institutional quality rates with predictable, locked-in returns that won't fluctuate like money market funds. 3. State tax benefit. T-bill interest is completely exempt from state and local income taxes, while money market funds distributions are fully taxable at all levels. If you live in a high-tax state like California, New York, or New Jersey, the benefit can add to quite a bit. Bottom line, T-bills are perfect for cash you can commit for specific time periods. If you know you won't need $50,000 for 6 months, T-bill gives you institutional returns with essentially zero uncertainty. I won't say that they're necessarily better than money market funds, but they're ideal when you can match your cash needs to their specific maturity dates. Thank you guys for watching the theme of cash. If you want to learn why I believe cash is king and why I firmly believe it is important to hold a healthy amount of cash, please check out my video here. Until next time, all the best.